All right, hello and welcome everybody. We made it. I finally got everything working. Gotta love technology. And if you're like me, you want everything working perfectly all the time, but sometimes technology just wants to do its own thing. So I know we're a little bit late here. Hopefully you guys can tune in and still watch, or maybe you can catch this later if you decided to go outside and enjoy the weather. It's very nice here out in California, but the things I want to talk to you about today, I think are actually really important, and I think they're actually really pertinent to right now, actually. So hopefully you can catch this now or you can catch this a little bit later, but if you happen to tune in, welcome. My name is Jason J. Hamilton. I am a charter retirement planning counselor, and I am the admin of this group. And so I'm really happy to see you guys today and have some really important things that I think are going to really open your eyes a little bit to what's going on in the financial industry. For those of you that don't know, I'm pretty passionate about operating as a fiduciary. And so what that really means is, at the end of the day, working as a financial advisor that is legally required to work in my client's best interest, okay? So this industry is not quite what it should be. But in case you didn't know, there are some things that are going on right now at the SEC that we're really trying to clean some of this stuff up, right? We're really trying to get these things to be better and to make every single financial advisor have a legal requirement to work in your best interest. But unfortunately, that's just really not the case right now. And the brokerage industry is fighting very, very hard to keep their ability to really keep you in the dark at the end of the day. So I feel like the best thing I could possibly do for you is just to educate you, and so that you can make the best decision for yourself at the end of the day, because that's what I want, right? So this group here, Your Retirement Coach, is a place where you can come, ask questions, get really good answers, and not be sold a bunch of hype and a bunch of products that you really don't need for retirement, because I honestly think that's one of the biggest things plaguing the industry right now. And I think it brings a lot of folks that are looking for someone to help them with their retirement planning. It brings a lot of apprehension, right? It's really hard to find somebody you could trust. And at the end of the day, there's not a lot of disclosure in this industry, and it's just bad. So what I want to do is just go over a couple things with you and show you a couple things. And then I also have a very interesting report that came out from, who is it? It came out from, let's see here, from JP Morgan, okay? So I have a really great report to share with you, and we're actually going to be covering this report over the next few weeks because there's just so much good information, and it's just really everything about retirement, okay? We're going to talk about statistics, long-term returns, looking at different things around long-term care, longevity, a lot of good stuff in there. So let's just jump right in so I can show you this here, because I think you will find it very, very interesting here. So let's talk about this first, okay? So, you know, like I said, I'm a big fan of the fiduciary rule. Let me see if I can get myself. I am in the corner here. Okay, great. I'm a big fan of the fiduciary rule, but that rule was completely shut down at the end of 2016. And what they're trying to replace it with is something called Reg BI, or Regulation Best Interest. Okay, so in reality, this is another one of those tricks where it sounds good, right? Best interest, like it's going to be in your best interest, but in reality, there's a lot of loopholes in it. And some very powerful industry advocates are pushing for this, but there's a lot of lobbying money that is coming in right now from the huge brokerages, because if this goes through, in all honesty, they're going to lose a lot of money. But the good thing is that means for you, the consumer, you're going to be in a better position to get help without getting ripped off, right, at the end of the day. So I want to make you aware, one, of what this is, okay? So I'm going to pull up this article. If you want this article, feel free to send me a message. I'm happy to share it with you. But it's really a call around Reg BI. Okay, so this last week in the SEC, they have a new proposal for broker regulations, okay? And it's really expected that in its current form would actually be more harmful to investors than no rule at all, because last week we talked about the difference between fiduciary and suitability, right? So I think you're pretty clear on that. But what this is really just another suitability rule cloaked as a fiduciary rule, but it doesn't really meet the same legal obligation. And you as an investor just don't have the same protection as you would. So I want you to know about this, because this, like it shows here, the regulations offer the appearance but not the reality of increased investor protection. So this is from the chairwoman, of the CFP board. Okay, and Barbara Roper is somebody you should follow on Twitter. She is all over this stuff. She's really, really wonderful, and she's very, very passionate about creating a real fiduciary standard that you deserve as an investor when you look to get somebody to help you with your financial matters, okay? So what she says, and I agree with this actually, is that it does more to weaken investor protections than to strengthen them, okay? And I do agree here that indeed no rule would be better than the current proposal, okay? So a lot of folks are really pushing against this, but if you go in to whoever you're working with and you ask them, are you a fiduciary, okay? They may say yes or they may say no. If they say no, obviously you can kind of walk away from there. But if they say yes, I really want you to download that form that I attached to the video last week and have them sign it. That is a fiduciary oath that they are required to do what's in your best interest first before their own, okay? And to me, it doesn't make any sense not to do that, but that's really where this industry is at right now. So I want to protect you and help you get the right type of advice, and that you can work with somebody that is going to be willing to legally work in your best interest and so that you're protected, okay? So if you want to take a look at this article, I'll post them down below for you later, okay? The second thing I want to talk about here, let's get this out of here. The second thing I want to talk about here is active versus passive investing, okay? So a big point of sale for these active managers, okay? So there's folks, let me kind of take a step back for a second first. In investment management, there's really two styles, and that's active and passive, okay? So if you've heard of passive, you're thinking that would be something like index funds, ETF, passive ETFs, and that's really just owning the market, keeping your fees low, and just keeping your asset allocation properly set and your asset location, which means where you keep what type of funds in the type of different accounts, because different funds perform better in different accounts. So taxable, pre-tax, and tax-free. You want to keep different types of funds in those different accounts and make sure you're optimizing your situation there. But there's this other field that's called active management, okay? And so a lot of investment advisors are active managers. And so what they're really saying when they are doing active management is that I can beat the market, okay? And when you look at all the data, I want you to look at this article as well. And I'm going to show this to you here. And here's the new data that just came out recently showing that basically it's a bunch of BS, right? It's really what it is. And what you can really control is the cost of your funds. You can control your taxes by the way you manage your funds, but really trying to beat the market, not saying it's impossible, because it is possible, but you're going to look at an 8% chance of that happening, okay? So would you rather have a 92% chance of performing very well or an 8% chance of potentially outperforming? If that's for you, then that's okay. But for most folks, passive management is going to be the way to go, okay? So what I want to share with you here on this article is that active fund managers trail the S&P 500 for the 9th year in a row compared to indexing, okay? So indexing, what that really means is you're going to buy an index like the S&P 500, okay? You might buy the Russell 2000, which is more of a small cap type of fund. You can own a bazillion different indexes, right? And most funds, like let's say you have a growth fund, the growth fund is going to have an index that it's trying to beat, okay? So if you have a growth fund, that's probably going to be trying to beat something like the S&P 500. But there are funds that charge fees of 1, 2, or even up to 3%, promising you that they can outperform the market, okay? So this study, again, 9th year in a row, has proven that there's a very, very small chance that these funds are not going to outperform long term. And so you're better as an investor just to control your cost, keep that extra 1 to 2% in your earnings and not paying it out to an active manager, and then really just owning the market and being patient and rebalancing when it's the right time, okay? Instead of trying to jump in and jump out, there's been no proof that anybody anywhere can time the market. So just owning the funds, getting the right asset allocation, and keeping yourself invested, and then rebalancing if the market has volatility so that you can capture things at a lower cost per share. That's what's going to really outperform long term. So if you look here, for the 9th consecutive year, the majority, which is 64.49% of large cap funds, lagged the S&P 500. After 10 years, 85% of large cap funds underperformed the S&P 500, and after 15 years, nearly 92% are trailing the index. So a couple other things that are really interesting in here is that you have these active managers who claim that they would do better during periods of heightened volatility. They're going to have to find a second argument, right? Because in reality, this is what they say. that, hey, we may not beat the market, but if the market has a downturn, you're not going to go down as far. Okay, and this data here shows that that's just simply not true. Okay, so as a consumer, I want you to be smart, right? I want you to be smart. And I want you to do the things that are in your best interest at all times. And I want you to stay in the market. It's another thing. But paying somebody an extra 1 or 2% of your investment portfolio each year to sign up for a myth that they can outperform the market is just something that's just really, really, it's not true in reality when you look at all the data, okay? And then the other challenge is, well, let me take a step back. Long-term, the numbers were not much better in other categories as well, okay? So over long-term horizons, 80% or more of active managers across all categories underperformed their respective benchmarks, okay? So when you're dealing with folks, again, and it's usually, you get a mix, but it's usually folks that are trying to upsell you on some sort of investment strategy, helping you understand why you're going to pay 1.5, 2% for your assets under management fee. It's just a bunch of smoke and mirrors, guys. So, I think some of you guys might know, but when I came into this industry, I was looking to get involved in a fiduciary manner, and it's such a small percentage of the industry that's willing to do this because these stories and these myths actually sell really well with investors, and a lot of investors do buy in to this that their investment manager is going to outperform. So that's why I decided to take a different approach, and I approach it more from a financial planning aspect, and I'm really focused on what can we control, right? We can control taxes, we can control costs, and we can control rebalancing your accounts and buying all the way down and making sure that you are getting the best cost per share over time, because when you do that, that's what's really gonna outperform for you, okay? And then here's the other thing that I want to talk to you about is survivorship bias, okay? So many of these active funds, they become liquidated. So what that means is they underperform for so many years, and then what they do is they liquidate those, so they sell them off, and then they absorb those funds into another fund that seems like it's doing better. And what happens over the long term is that it's kind of hidden, right? This long-term performance is sort of hidden, and you can't get the data you really need. So as an investor, that puts you in a position to where it's a little bit tough to make sure that everything, your portfolios are performing the way you want them to perform, okay? So like it says here, the disappearance of funds remains meaningful. And over 15 years, 57% of domestic equity funds and 52% of all fixed income funds were merged or liquidated, okay? So that's, over half are not, they're merged or liquidated because they're underperforming. And so, again, stay away from the smoke and mirrors, guys. Really focus on getting what you can get right. Focus on what you can control. Having a diversified portfolio with a good set of funds that's globally diversified, not just the S&P 500, that is not diversified enough. You need to have a mix of small cap, some international, maybe some emerging markets, and then you want to have multiple, different bond durations in your portfolio so that you're capturing the increases in gains, but also keeping that volatility down. Because if you don't know, keeping your volatility down actually improves performance as well. So that's why a lot of times, a 90% stock portfolio can perform better than a 100% stock portfolio, especially when you can rebalance and capture those losses when the market is down and get a better cost per share. Okay, so hopefully that all makes sense. If you have questions about that, go ahead and drop them down in the comments, and I will pull this up and I'll take a look at them there. The next thing I want to talk about here with you guys is something that I think is going to be really interesting. Let me pull this up so I can see comments here really quickly. Pardon me. And this report here, okay? Every year, JP Morgan comes out with this guide to retirement. And honestly, it is really, really wonderful information. I would highly recommend that you check this out. And I'm happy to put the link in if you guys want to have this. But if you don't want to read a bunch of data and try to figure it all out yourselves, don't worry. I'm going to be here for you. We're going to cover a lot of this. I think there's some really good stuff in here that you should know as a consumer that's planning for retirement. So a couple things here that I think are going to be really interesting. Let me pull these up here, okay? So I want to talk about first the retirement equation, okay? So retirement equation has some things in here that we can control, some things that are somewhat in our control, and some things that are completely out of our control when it comes to our retirement plan. Well, really creating a sound retirement plan, okay? So as I was just speaking about, when it comes to your investment portfolio, asset allocation and asset location are something that you can definitely control. If you've never heard of these terms before, let me explain them really quickly so that you can be on the same page here. So asset allocation is how much money you have in, let's say, stocks or bonds, okay? Or maybe you own a little bit of gold if that's something you're into. But the allocation of your money in the different asset classes, okay? So that's what that is. And then asset location is where you actually keep certain types of funds in your different types of tax advantage tax advantage or non-tax advantage accounts. So in a 401k, for example, where you have tax deferral, you don't really, it's great to have things like your bond funds, because if you have bond funds that are not inside your 401k and are just in a taxable account, the gains on those are going to be fully taxable at your marginal tax rate, so your normal tax rate. Whereas if you have, let's say, a index fund or a stock that's outside of your 401k, the most tax you're going to pay on that is capital gains, as long as you've held it for a year, okay? So that maximum rate for most people is 15%. It can go up to 20 if you're high income, but for most people, it's going to be between 0 to 15%. So where you keep your money and where you keep your investments, and the location of them can actually have a big impact on your overall performance and your overall net returns that you see after taxes, okay? A big thing that we're very passionate about is after-tax wealth. So when it comes to going into retirement, some things we look at, and we've talked about these here in the past, is how do we maximize your after-tax wealth? Should we look at converting some money from pre-tax to tax-free? Should we be saving extra money that's outside of retirement accounts so that we can use that without having to worry about activating taxes like you would every time you withdraw from your 401k? That's what asset allocation and asset location, that's when those come in really handy. And those things are 100% in your control, okay? The second thing that's 100% in your control is your saving and your spending, right? Sometimes I think our saving or spending may feel out of control because life hits us. We have things that come up and things that we feel, that don't allow us to save or cause us to overspend more than we'd like to sometimes. But in general, we do have control over those things, okay? And then when it comes to employment, earnings, and duration, like how long you work and things like that, we have some control over that, right? So you have control if you want to switch jobs and go to a new job, you have control over that. You may get let go at some point, and that's not in your control, and that's why we say some control there. And same thing with earnings, right? If you go to get a new job and they make you an offer, if it's not up to your expectations or what your needs are, then you have control over that and saying that, hey, I don't want to take that job because I need to earn more. But when it comes to getting raises, sometimes we don't have control over that because the companies are either going to set a certain standard or whatever it may be, okay? And then longevity, I actually like this, right? So I think a lot of people don't think they have too much control when it comes to how long they live. But in reality, we do, okay? And we're not talking about here like freak accidents like getting hit by a bus or maybe some genetic things that we have no control over. We're talking about, are you eating healthy? Are you exercising, right? Are you getting out and going for a walk every day, getting some sunshine and, really upping your heart rate by doing some cardiovascular exercise or maybe some light exercise? Because those things have such a big impact. They have such a big impact on your overall health that I do think that's somewhat in your control, and I think it's more than you think for a lot of people, okay? Some things that are out of our control are things like market returns, right? So going back to what I was saying, these active managers acting like they can absolutely control returns. We can control returns when it comes to your fixed income because we know that if we buy you a bond, for example, that's going to pay a 5% coupon, that you're going to get a 5% return on that on the bond, right? So that's pretty easy. But overall market, the stock market in general, we kind of don't have control over that. Ideally, when you look at the last 50, 60, 100 years, it's gone up over time, but we've definitely seen some significant dips. And so we can't control that on a year-to-year basis. But over time, it is a great place to be if you're looking to get a above inflation return on your money. And then this policy here regarding taxation, savings and benefits. Again, some of these things are voted on, but some of them are just totally decided by the government, right? So when it comes to your retirement equation, I'm a big fan of just really focusing on what we can control, right? And then doing the best we can to set ourselves up for the most success with all the information that we know now with the things that we can't control, okay? So hopefully you can relate to that and that makes sense for you, okay? Some other things I want to talk about here are life expectancy and probabilities. So I thought this was some really, really interesting data. Okay, so planning for longevity is really important. Okay, and this ties into things like timing your Social Security, when you're going to take your pension, when you're going to start taking withdrawals from your retirement accounts, maybe how much you're going to take out. And so I want to show you this data because I think a lot of people don't quite, understand that it's a lot different than what the general knowledge is. Okay, so if when you talk about longevity, if you just do a quick Google search and you use from age 0, so when people are born until the end of their life, and it'll say maybe 74 or 76, right, as the average age. So 74 for men and 76 for women. But that includes infant mortality and all these other things along the way. What I want to talk to you about is if you're 65 today, the probability of living to a specific age and beyond, because this is much different than you would think, okay? So in purple here, we have women. In gray, we have men. And then the green is if there's a couple, the chance that at least one person lives to that specific age, okay? So if you're currently 65 today, or somewhere near it, then if you are a woman, you have an 86% chance of living to 75, and a man has a 79% chance of living to 75. But one member of the couple has a 97% chance of living to 75. So if you've watched some of the Social Security workshop we've done, when we look at break-even points for delaying Social Security, let's say to full retirement age, most folks are going to break even somewhere between 74 to 78 or so. That's kind of the general range. And then at 80 years old, you have 73% chance for women to live to 80 years old, and a 63% chance for men to live to 80 years old. And if you're a couple, there's a 90% chance that one of you is going to live to 80 years old. Okay, so again, a lot of folks think they're just going to pass away, so they want to take their Social Security as early as possible, and they're not really looking at these longevity numbers. And in reality, this is going to be going up a lot. And this is a big topic of conversation in the retirement planning community, is that having a bigger Social Security benefit is just going to be so important to your long-term financial health, because if you take it too early and you end up living to in your 90s, it's really going to be a little bit painful if that's all the money that you have coming in for you, okay? So the next thing I thought was actually really interesting is when you go to 85 years old, looking at a couple, there's a 74% chance that one member in your household is going to live to 85 years old. So that means 3 out of 4 couples are going to have at least one member that lives to 85 years old, okay? So what does that mean? Well, if you're 65, 20 years from now, okay, things are going to be a whole lot more expensive than they are today. So this is something that, again, planning things like when you draw your pension, withdrawal rates from your investment accounts, and timing on Social Security becomes extra, extra important, okay? And this statistic here, actually really shocked me, that there's a 48% chance that one member of a couple is going to live to 90 years old, okay? So that means 1 in 2. I don't think most of us have really thought that through when it comes to our whole financial picture, that there's going to be a 1 in 2 chance, a 50% chance nearly, that one member of your household is going to live until 90 years old. Okay, so these numbers, I was really, really surprised, and I kind of knew it, right? I knew it based on my research, things that I've seen. But, the fact of living until this age can be really detrimental, honestly, if you don't get your financial picture in order, okay? It's really, really important to make sure that you're planning for longevity when it comes to doing your retirement plans, okay? So a lot of folks think they're going to pass away at 75, 80, 85, but it's not really like that, So when you have a conversation around when do I take Social Security, what's going to be our plan for long-term care, these are big percentages and a big probability that you may have to really plan for a very, very long life. And you're not just going to kick the bucket, like I hear some folks say, at 75 or 80, early on. So I thought this was really interesting, and I wanted to share that with you. So if you find this interesting, please, let me know in the comments. I'd love to hear from you. If you were surprised that there's a 50% chance nearly that one of you is going to live until 90. Oh, and a little side note here. If there's a lot more same-sex female couples coming around, And there's actually a 55% chance that one of the if it's a single sex couple, is going to live until 90, and a 40% chance that a same-sex male couple will live till 90, okay? So again, even more important for female couples to make sure that this is all taken care of and that you plan for this. And the reason I bring it up is because when one member passes away, that Social Security benefit, whoever has the largest benefit, that's what's going to be left behind to take care of the spouse. And as I talked about last week, the average time that women are outliving men these days is about 14 years, okay? So that's a long time to suffer if you don't have enough financial resources, okay? I'm going to cover more of this stuff coming up over the future weeks, but there's a couple other things I wanted to talk about really quickly here before we wrap up today. Let's see. We'll talk. I'm going to dive into this Social Security. We're going to dive into this quite a bit in the future weeks, okay? So I want to talk here about spending and inflation. Spending and inflation. Okay, so inflation on average. I'm sorry. Let me take one step back here because I want to talk about the average inflation really quickly. Hopefully, I'm not making you too dizzy. Sorry about that. Oh, I did want to cover this before I jump to that section. I guess I passed it here. Okay, if I'm making you dizzy, sorry. Don't throw up on me. I'll get right here. Not seeing it. Okay, I'm just going to skip that. No big deal. Okay, we'll come back to that. But, average inflation numbers are really important to consider when it comes to your retirement planning. So when you look at inflation, what that really means for you as a retiree is that how much is it going to cost you, to keep up with a comfortable living situation, right? And not have to make adjustments, later down the road when you maybe aren't ready to do that, and you want to be settled and you're a little bit older and you want to just kind of be done with things. But it can be really dangerous that if you don't plan for this, and this is why, I'm not saying everybody needs to have, a high risk portfolio. I don't think that's proper at all. But I do think you should keep a portion of your assets that are set aside that you don't really need in the short term, especially if you have a low risk tolerance, right? But you keep a set of assets aside that are going to grow and outpace inflation, because when you look at these numbers here, it's pretty scary if you were to really look at the how this maps out long term. Okay, so most things when it comes to inflation, we usually plan for a 2.5 to 3% average increase in cost of different things like that. But some of these things have stayed in that range. So food and beverages, travel, housing have all stayed pretty close to that. Transportation stayed, actually a little bit lower. Entertainment has gone down. I think there was a huge thread the other day in the group here talking about, ways to save money. And I know cutting cable is always one of them. Netflix and Hulu. I haven't had cable for like 7 or 8 years at this point, so I'm all on board with that. And the cost of clothing, apparel has gone down quite a bit, okay? But the big number that really concerns me here is the cost of healthcare, okay? The cost of healthcare has gone up on average about 4.8% from 1982 to 2018 per year. So that's actually really, really scary. I think a lot of you folks, if you had a 5% guarantee on your retirement accounts, you'd feel very comfortable, keeping your money very conservative. But obviously we can't get that right now necessarily. But that's a number that I think is really, really scary. And then the cost of education, if you have children or grandchildren, is something that can be a little bit scary as well. So these are things that I thought were really interesting that you want to keep track of. Some other things here, when it comes to spending by age and category, I thought were very interesting as well. So the gray is 55 to 64 years, and then the purple is 75 plus, okay? So what's interesting is what we expect is that like most spending will go down over time, especially when you are getting a little bit older in age and maybe you've hit your bucket list, you've done all the things you wanted to do, and kind of had a lot of fun and got that out of your system. But as you can see here, healthcare definitely increases. Housing increases as well. So this is excluding mortgages, right? So if you have a mortgage, you're pretty much set right there. But renting versus owning in retirement, that question comes up a lot because owning, you have to take care of everything. Renting is kind of nice because if something breaks down, you put an email into the landlord, they come take care of it, and nothing comes out of your pocket. But the cost of housing could go up, but it's actually not as extreme as you would think. because, when you take into account fixing roofs, if a pipe breaks, things like that, home ownership is not cheap, to put it lightly. So those are some things I thought were really interesting. Food and beverage pretty much stays the same. Travel stays the same. Transportation is higher before 75. That goes down a little bit, which is great. And then, charitable contributions go up, right? So hopefully you find this interesting, that and if you want this report, I can post it down in there. So we're going to cover a little bit more of this today. But what I wanted to talk to you really about was some of these things that are going on in the financial industry, because I want you to be protected. I want you to make sure that you don't get ripped off, because if you get ripped off at 65 or 70, or even in your 60s or 50s, and you have to recover from that, it could be really, really difficult to make up for those losses in that short amount of time. I deal all the time with folks in their 30s and 40s that got ripped off, and so they don't go seek out financial advice, and that's unfortunate, right? But the same thing happened to my parents, which is why I do what I do the way I do it, because I just want to keep everything as clear as we possibly can, and just, straight fiduciary, pay for service, and that's just what it is. So that's what I recommend for you if you go to look for an advisor, that you are paying for a service, you're not paying commissions, you don't buy a bunch of stuff that you don't really need, and products and stuff like that. So be smart, be a smart consumer, and make sure you're protecting yourself and your money, okay? So that's what I wanted to talk with you about today. If you guys have any questions, you need any help, please let me know. I'm happy to help you out with that. My website is keepitsimplefinancial.com. If you want to schedule an appointment with me to talk, you can go to keepitsimplefinancial.com/talk, and I'll be happy to chat with you there today. Before we wrap up, I want to share with you a really cool story that someone this week scheduled an appointment with me, and it was really nice. It was really nice because I think a lot of people in this group get nervous to maybe schedule an appointment and spend time to see, like, hey, should I get help? Where am I at? What am I looking at when it comes to retirement? Am I on track? Am I doing all the right things? And they freak out because they think, oh, I don't have $1 million, right? And it's really tough because most people don't have $1 million, guys. Sorry to break it to you, but that's the reality. And so we get a lot of folks that see some of the big numbers in this group and think that they need all this money to be comfortable. And sometimes that's the case if you're a big spender. But in reality, the way I look at it is, it doesn't matter how much you have, it's what you do with what you have, right? And so just being able to speak to people that want some help, and even if it's not a good fit for us together, that's okay, but I'm able to at least get them on the right track, give them some tips and some ideas on how to get everything in order to make sure that they're in a good shape for retirement the next couple of years, and then maybe when they retire, they can get some additional help at that point. I love that type of stuff. And I just had such a great experience yesterday with somebody who was just so sweet and so nice. And so I really appreciate that. And I love reaching out and connecting with you guys. So if you ever want to reach out and talk to me, don't hesitate. Schedule a call. If you want some help, I'm happy to help you out. And if you want to work together, we can discuss that too. Okay. So once again, it's keepitsimplefinancial.com/talk. I'll post a link in the comments down below after. But other than that, guys, I'm going to check for any questions you have. And if you don't have any questions, I'm going to wrap up for today, because I had a really fun time, not a really fun time today with this tech issues that I had going on. So I'm going to take a look here for questions before we wrap up. And let's see what we have here. Okay, so Barb says, retiring soon at age 70, thinking of moving my company 401k to an equity and fixed income mixed portfolio, ? Right? So yeah, Barb, I think that could be a really great idea, right? Here's some things that you want to think about. That you want to have some equities in your portfolio, but you don't want to have too much, okay? If you have too much and the market, maybe takes a little bit of a downturn or has some volatility, then you're going to freak out and get out of the market. I saw a post today inside the group and talked about some people with TSPs and are all in the G fund, which is a fixed income fund, which is very safe. But if you don't need the money today, if it's going to be, if you're going to have it for 15 or 20 years, and you missed out on the first quarter so far this year in the investment portfolios I manage, we're somewhere between 8 and 11% depending on equity portion, right? You would have missed out on all that gain, and you're sitting there getting 1% or 2%. So having some equities in your portfolio, I think, is a really, really smart thing to do, and it can protect you not only now, so you can have a little bit extra spending money when the market does well, but for long term, because like we talked about earlier here, you might live a really long time. Okay. I know some of you think you're going to pass away in the next 2 years. It's not likely unless you have something that you know about. It's more dangerous that you are going to live longer than you expect, and that's what scares me more than anything else, okay? So yes, Barb, I think that'd be great, but I recommend that you go through and you get a really clear financial profile and you do a deep dive into your risk tolerance, your income needs and your goals, and take a look at, what return do you really need to generate to be comfortable and outpace inflation, and then set up your portfolio to match that. Okay, so that's what I would say on that one. If you want some help with that, let me know. Let's see here. We have a Barbara. Barbara says, I fully expect to live into my 90s. I am 63. I plan to work as many years as I can with the goal of retiring at 70. Barbara, I love you. I feel the same exact way. I'm planning now for me to live to be 110 or 120. So I try to take care of myself. And then financially, again, preparing that way in case I do live a really long time, that I'm ready for that. And I love what I do. And some of you folks don't, and that's okay. I would get the heck out of there too. I worked the corporate grind. I was a corporate manager for 9 years at a S&P 500 company. And it was great for about 4 or 5 years. But then after that, it was just you become a number. You have no control of everything. Every time you want to take a vacation, it's a drag. So I get that. But I think working and keeping yourself active, I think 70s, as long as you're working part-time and keeping yourself active and you take some good vacations, nothing wrong with that. I love that, Barbara. I love that, and I love your attitude about that. Scott says, please post a report. I'll post that for you, no problem. Yeah, I got a lot of that for post a report. I'll post that for you guys, no problem. And we're going to continue to talk about it. So if I do post a report and you end up printing that out, bring it with you to our some of our next sessions, because I'll be diving deep, because there's a lot of stuff in here. Okay. And then Cynthia said, keepitsimple.com/miss the ending. So it's Keep It Simple Financial. Keep It Simple Financial. I have a little thing here, but I can't find it. Give me 1 second. I'm going to find this thing so that we can have that. It's not coming up for me here, but let me just type it up. Let me do a new one. keepitsimplefinancial.com/talk. keepitsimplefinancial.com/talk. And I'll post that in the comments, so don't worry about that. Dwayne says, should lower earning spouse take at 62? That could be a good strategy, but Dwayne, something you want to consider is if you're looking at something like a partial Roth conversion strategy where if you have a bunch of money pre-tax and you want to get some of it over to tax-free before you turn 70, you may end up paying a bunch of tax on that money. So 62, 63, 64, taking it a little early is great, but you want to take into account not only just the Social Security situation, but all the different aspects, okay? Because it's like putting together a puzzle, like a retirement plan. And I tell people this when I talk to them one-on-one, is that I see things in like a puzzle, right? So when I'm speaking with folks, finding out about their situation, I look at things, okay, I have this puzzle piece, I have this puzzle piece, this one, and this one. So you have Social Security, you got your retirement accounts, you got pensions, you got other fixed income sources, you got cash. How do we get all those things together, optimized like an orchestra, so that we are getting you the most tax-adjusted wealth? So I think that decision, it can be good, but I would look at all the other pieces as well, and don't just make it on an island, Dwayne. I think that's really important, okay? And then, let's see. Scott says, what's the best way to invest and build a bridge account for retiring early, bridging from 55 to 59? Okay, so I'm a big fan of, like a bucket type strategy where you keep a certain percentage of your money for those type of years, so 55 to 59. I'll probably do 5 years, for example, right? So 55 to 60. And then years 1, 2, and 3, those would be extra conservative. And then for years 4 and 5, I might go a little bit more like a longer term bond or something like that. But, I'd have to design that. But I'd create like maybe a bond portfolio or like a CD ladder, some cash, getting at least 2% in my savings accounts. And then from years 5 to 15, then I would want to have a little bit of a more risky portfolio, not high risk or anything like that, but something where you're earning beyond, inflation numbers. And then for years, 10 and beyond, then you could, add a little bit more in there. So, but for the first couple of years, you probably just want to keep some cash or CDs in there, and then every year sell off a little bit of the rest of it and dump it back into that account to fill it up, and make sure you have a good cash flow plan so you don't underestimate that. So I think that would be how I would think about it. And that's all I'm seeing here for questions, guys. So I will be wrapping up for today. I appreciate you watching so much. Hopefully you learned something today, took something away, and that you're going to make at least one smart decision for your retirement this week. Because if you do that once a week, and that's all, if that's all you did, you'd be making 52 smart decisions this year. And so that's what I want to help you do. All right. Once again, my name is Jason Hamilton. I'm the admin of this group. So if you ever need anything, guys, feel free to tag me in the post. I'm happy to respond to you. And other than that, have a great day, and we'll see you next time. All right. Bye-bye now.